Kia ora koutou, and hello and welcome everybody, especially of course our people from the Northern Hemisphere who have kindly woken up in practically the dead of night, although it's 6:30 in the morning, and so therefore the coffee intake has to be high. Thank you so much for coming along and joining us. So thank you very much, and I'll introduce you in a moment, but first of all I just want to say thanks and welcome to all our participants. I'll just say a word on how the seminar is going to be run, then I'll just introduce Arun and Robert. We will be keeping pretty well running a tight ship. What we'll do is hear from our two speakers, Arun first and then Robert, for about 10-15 minutes, kind of, more or less. And in about half an hour, 35 minutes, a general discussion with questions and answers, both amongst ourselves, but of course, especially to our two speakers. Of course, we're talking about wealth and about taxes. It's complicated, boy, and if you dip into the literature here, as espoused by Arun in particular, and his colleagues, boy, you get to know just how complicated it is. Arun is an academic, he is an economist, and he works in University of Warwick in England. He has also spread his interests in many ways, and in particular, he has, I think, more or less certainly very actively involved in the Wealth Commission. You know, we're really keen to hear about your views on how wealth taxes fit with other kinds of taxes and what the politics of it, what the policy is, what the economics of it, you know, all that in about 10 or 15 minutes, I'm sure. And then Robert will take over. Robert is Tax Justice, he's the Director of Tax Justice UK, so a campaigner, and I'm sure an academic at heart as well, but perhaps first and foremost, certainly at the moment, an academic, a campaigner.
Yeah, great. Thanks, Louise. So let me take just 2 minutes first to tell you sort of how we got to the Commission.
Yeah.
So I'd already been working as an academic on tax in the UK, kind of what different people pay. You know, one of the questions you might have if you're a tax justice person, you might say, well, you know, the first thing to think about is, well, what are the different tax rates? Like how much the taxes increase? The UK has what is at headline level a progressive system. We have a bunch of people who don't pay tax. They're below the threshold for paying any income tax. I mean, they pay other taxes, but they're below the income tax threshold. Then there's people who pay 20%. After some point, they pay 40%. At some point, they pay 45%. So, you know, it looks like a kind of fairly standard progressive system in some sense. And you can argue about what the top rates ought to be, but you can see that it has that kind of structure. We actually had access to the data that the tax authority holds. So we could look at what people actually pay, not just what do the headline rates say, but, you know, what do they actually pay in practice? I think the thing that's really striking is, although you sort of think, well, the share of your income that you pay in tax will be rising in this way, it'll just keep going up and up because the rates keep going up and up. What you actually see is that it increases up to some point and then it actually drops off. And this is why we think of like the taxation of wealth or the taxation of capital as the really kind of crucial thing. You know, why does it drop off? It drops off for two reasons. One is that there are various tax reliefs out there. Those are important to think about. We have lots to say about them in the UK. They're also very parochial because every system will be different. But the other that's really crucial, and is actually kind of the biggest part of it, is the taxation of capital being different from the taxation of labor. So we tax people on what they earn from work or self-employment. And we have that 20, 40, 45% is the headline rates for that. We have lower tax rates on dividends, which is the money you get from, say, from shares that you own. And that means that already you have some incentives to try and structure your work if you can. If you're wealthy enough, you can set yourself up as a company, you can put money through the company and take your money out as dividends. You can pay a lower tax rate. So that's one thing you want to do. The other is we tax capital gains at much lower rates as well. And so that creates a much bigger incentive. So capital gains being the increase in the value of an asset between when you kind of buy it or create it and when you sell it. That big gap in tax rates between capital gains rates and income tax rates means there's another way in which you get money out at kind of relatively low rates. And that's why we see this kind of drop off in the tax rate, the share of income that people are paying in tax. The other reason that's really important, I think, for a group like this, the tax justice type group, is that it helps you build a coalition. Thinking about that kind of idea helps you build a coalition across sort of the left-right divide. Because I think, you know, there are lots of arguments in the UK about what should that top tax rate be. It was 40%, you know, pre-financial crisis. It went up to 50%. It went back down to 45%. But there's lots of political argument around that. I think what nobody really finds justifiable is the fact that when we look at kind of a bunch of wealthy people, there's a huge range of tax rates they could be paying. If all of their income is basically labor income, It's rare for people in the UK on the left to be crying for the bankers, but the bankers, pretty much pay that 45% rate on their extra pound they earn, because there's not a lot they can do to shuffle their money around. They may have some tax reliefs, but they're pretty much paying that kind of rate. On the other hand, if you're setting up yourself up as a consultant, you work for one of the big consultancy companies, you could leave that company, set yourself up as a private consultant, and take your money out as capital gains, and you can be paying as little as 10%. And so that kind of striking gap between the 45% and the 10% is something that means that, if you're, whether you're on the left or on the right, that's like strikingly, obviously unreasonable, that there are these big gaps. And so I think that's a really important discussion we had in the UK. That's actually something that you can kind of build a bridge across parties on both sides around the fact that's unreasonable. That led to some work that we did where actually a statutory office in the UK, it's called the Office of Tax Simplification, but it sort of reports to government. It's tasked by the Chancellor to look at things, the Finance Minister to look at things. They were asked to go and look at the taxation of capital gains and whether it should be reformed. And in the UK, we have a capital gains tax system. It's been reformed roughly every 10 years. But I was then involved in the review that looked at whether we should reform capital gains and essentially increase that tax rate to make it more like the income tax rate, which we used to have, and have some kind of allowance either for inflation or what you'd call a kind of fair economic return. In the UK, we call it the rate of return allowance, but have some kind of allowance for a certain amount of return that you expect people to be able to get, and above that tax. And I'm happy to talk more about capital gains if anyone has that in questions. But I think all of this led us to, this is sort of what I was working on pre-pandemic. Then the pandemic happened, and a bunch of different journalists were writing about the fact that this was going to cost lots of money, and we were going to need to find a way to raise kind of huge amounts of cash. And there were a couple of people who said, maybe a wealth tax is a good idea. So, I'm an academic and I work in this area, and I kind of wanted to think about what do we know about wealth taxes. We sort of looked back at what is the literature on wealth taxes for the UK? What do we know? And we basically discovered the last serious thinking about it was done in the 70s. And thought, well, the world has changed a lot since the 70s. People move around a lot more. Money is more mobile. There's all kinds of different changes in the legal system. This is not a great literature. There's not a great set of evidence to base a decision now. Like either saying a wealth tax is a brilliant idea or saying it's a terrible idea. Some people who ideologically want to say it's amazing. Some people want to say it's an awful idea. And both of those seem kind of unfounded in the absence of any good evidence. So what we really want to do is to understand, is this a good thing? Could it work? How would it work? And so together with two other people, I founded the Wealth Tax Commission, which studied whether the UK should have a wealth tax. And in particular, the way we designed that the structure of what we were thinking was as kind of a bunch of separate evidence papers that covered different issues about a wealth tax. And that was important because, again, in this kind of context, one of them is on the wealth distribution in the UK. That is almost entirely irrelevant to you in New Zealand. I mean, one thing that's sort of interesting is that I think Max Rashford has some figures for New Zealand that says the top 1% have about 25% of the wealth. In the UK, we'd say the top 1% have about 23%. So actually, it turns out some of those numbers aren't that hugely different. But in principle, that's not what you need to know. But other things like what are the economics of a wealth tax? What are kind of the issues around evidence internationally from wealth taxes? What do some of the aspects of the legality of wealth taxes, some of the practicalities of how you value things? Some of those things, there are parts of that I think you can draw on. Some of those evidence papers really, I think, are quite usable internationally. And we wanted a plug and play type system where you could kind of replace, go and get the evidence you need on the particular parts of it, while at the same time kind of collecting just the evidence we've already designed and developed, the evidence base we've developed for those other areas, like how would you value it, or how would you think about people who are, asset rich but cash poor? One of the ones that always comes up is, there'll be someone who's, in the UK, it's stereotypically an old granny whose husband has died and she lives in a fancy house in central London, which she now has basically a low pension, but has this family house that she's lived in for 70 years. How could you possibly take that away from her? And there are discussions about, there are solutions to that kind of thing, but there's there's an immediately an emotive argument that comes up. And so we have a whole paper on, how important is that case? How many of those cases are there? What could you do about it? And what do those solutions imply for the revenue you raise? So we set up this commission. It was me, Andy Summers, who's a lawyer at the LSE, so he's an academic lawyer, and Emma Chamberlain, who's a practicing barrister who works on the tax for the super rich. I should say, by a wealth tax here, what we mean is we actually looked at two different options. We looked at an annual wealth tax, which is every year you value people's wealth and you charge them a certain amount based on the value of that wealth. Pick a number at this point. I'm not taking this number seriously, but say 1% of their wealth above some threshold. So you could pick a threshold of, say, £500,000. So in the UK, that would be about the top sixth of the population, and say, let's charge 1% on the wealth above that. That would be an example. So that's what we think of as an annual wealth tax. We studied that. We also studied one-off wealth tax. So the other thing we were thinking about was, in the context of the pandemic, you might say this has been a really big one-off shock. We're going to need to find some way to fund kind of the cost of this. One option, which is the classic option, is just like crank up the VAT, the sort of sales tax that we have in the UK. Another classic option is just crank up the headline income tax rates for most people, because those are both things we know will raise a large amount of money. Are there any things that are, relatively more progressive than that could be done? And could you have, say, a one-off wealth tax that would cover the costs of this to the extent that you think you need to cover those costs, and do it in a kind of fairer way, in the sense that the pandemic was nobody's fault. It's not about trying to punish anybody. It's that the pandemic happened. We are living with the consequences of it. And if we're trying to work out who should pay, then a sort of reasonable sense of natural justice is one in which those with the broadest shoulders bear more of the burden. And so that would be a reason why you might want to think about wealth as the basis for taxation, because by construction, it's not those wealthy people who are doing something terrible, but they have something that people who don't have wealth do not have. And so in some sense, they are more cushioned from economic shocks more generally. They have something they can rely on, and they feel naturally, in some sense, therefore, like a group that you'd end up going to more, rather than saying, well, we'll just do it based on the people who have income now. And there's two other reasons why that was kind of important in the UK. So one is, like much of the many high income countries, we've had a big reduction in interest rates, central bank interest rates over the last 15, 20 years. We're kind of starting actually really in the 90s, but it really kind of dropped post financial crisis. And what that's led to is a big increase in asset prices. That's led to a big increase in the share of wealth compared to income. So wealth used to be about 3 times income for the whole country. So if you take total wealth in the country divided by GDP, it's about 3. Now it's about 7. So there's a big increase, and that means that the people who don't have wealth, it's really hard to go and make it into that group who have wealth. It's not like you can just work your way up. That story that you might have from particularly people on the right, that you pull yourself up by your bootstraps, you work hard, and one day you'll be wealthy too. That's just increasingly difficult as wealth is that much bigger. However hard you work, however much income you have, it's just really hard to ever make it to having high levels of wealth. It's hard to kind of buy a house in central London or in the southeast of England, which is the kind of richer part of the country. That's just hard. If you're the smartest kid who works the hardest from the best school in somewhere in the north, and you grow up without some inheritance, you're just never going to make it there. That's what we know. The fact that that is the case means that there's a kind of one case for why you want to be taxing wealth more. That it's, even if you care about equality of opportunity in a very kind of typically more on the right side rather than equalities of outcomes, it would still be the case that there's actually now a situation where to achieve that, you probably want to be taxing wealth more. That was one reason. The other reason that was kind of important in the context of the pandemic for one-off wealth tax was that the pandemic has mostly been something that has been worse for older people in terms of the medical outcomes. Young people, for the most part, there are certainly tragic cases of young people who get very ill or who die, but for the most part, it's something that's been particularly dangerous for older people. And those are also people who are more likely to be retired, to not have an income, or to not have anything other than a pension income, or even potentially be about to retire. So if you have an income tax, which was the kind of main proposal that people were thinking otherwise, that's not really going to be taxing them very much, even though they're the ones who actually, in a sense, have most been affected. Whereas a wealth tax will fall more heavily on older people. People build up wealth over their lifetimes. But that, in this context, might be the right thing to do, because they're the ones who we're sort of trying to protect in some sense, who've led to these pandemic costs. So again, it's not about punishing anybody. It's about saying, look, what's the fairest way to think about redistributing these things? What do? We kind of developed, as I say, this kind of evidence base of, what does the wealth distribution look like? What are the economic arguments? And there are arguments for and against. I think the classic economic argument against a wealth tax, in a sense, is that it is sort of discouraging the idea of kind of saving. If you tax people for saving, then you're going to discourage people from doing that. No, that's absolutely true. It does. The question is, how large is that effect? Because there are lots of consequences of, say, taxing work. It discourages people from working. That's also not a great thing. So the question isn't, is it bad in principle because it could discourage something? Lots of taxes will do that. Sometimes you want that in a carbon tax, but mostly you're not trying to discourage the behavior. You're just doing something. So you don't want to discourage people from working, but a tax on work does that. The question is kind of quantitatively, how big is this? And the answer is quantitatively, the effect of taxing wealth is pretty small in terms of what it does to people's savings. So I think that's not really a big issue that we ought to be worrying heavily about. I think the other thing is that there's a lot of kind of, on the theoretical side, I'm not going to get into the deep theory, don't worry, but on the theoretical side, there are now more and more arguments explaining why it can be quite important actually to try and to tax wealth. That old idea that we had that taxing wealth is a bad idea economically, even if you kind of have other kind of equality reasons for doing it. The economic efficiency arguments that it will distort the economy terribly. I think we don't really kind of believe that anymore. And there's a whole series of things, and I'm happy to talk about those, but there's a whole kind of a raft of reasons why we don't think that's true anymore. I think if you're thinking about what makes it kind of really hard, the hardest part of a wealth tax, if you're thinking about a wealth tax, is really valuation. If you want a wealth tax and you want it to work, one thing that we know from the international evidence is you basically need to cover all kind of tax bases. So you have to cover all wealth. You can't say we're going to just exclude housing, or we're just going to exclude businesses, or we're going to exclude whatever, because whenever you look at any country that's done that, you see that there is a big shift in wealth from to kind of towards that excluded base. If you say you will tax all wealth except for housing, there'll be much more wealth. There'll be lots of people who go and buy some extra houses, rather than having their wealth in some other form. If you exclude businesses, people will structure a lot of their things into business. They'll get their business to own a bunch of assets. So there's kind of various problems around excluding assets. Some of those assets are kind of relatively straightforward to value. So for the most part, apart from very fancy houses, they're mostly fairly straightforward. You probably have some website in New Zealand, we have one in the UK, that you can go up and look on the value of your house, and it'll give you a pretty decent estimate. If you have good kind of big wide bands for what, here's your wealth tax if you're in this range, if you're in this range, if you're in this range, you're only really having to worry about people close to that threshold, and that makes it a bit easier. The hardest part is really valuing businesses. Businesses are really hard to value. And I think that was the thing that we found most difficult at the Commission when we were trying to work out how you do it. You can do it. Absolutely, there are people whose job it is all day to sit and value businesses, but it makes it quite expensive to do the administration. So our conclusions in the UK, in an economy, as I say, that has an experience of a capital gains tax and various other taxes on wealth, was that we would be in favour of a one-off wealth tax. You definitely could do doing a one-off case of all the valuations and things would be kind of straightforward. Take time, but what we recommended was a one-off wealth tax payable, even though you determine my wealth tax based on my wealth, say today, I pay it over, say, 5 years, because there's no reason the government needs the money today versus like paying it slowly. And that gives me time also to update some of that information. So this year I would say, here's what my wealth is right now, and here's my best estimate of it. I haven't managed to go and get a private valuation of my house, but here's my best guess. I haven't managed to go and get a private valuation of my business, but here's my best guess. And then I have, over the next 3 years, time to go and get those private valuations and update that. So I say, it turned out that my house on that date when I got a valuation was actually a bit higher or a bit lower. So in future years, I'll adjust my payment to make up for that. So for one-off wealth tax, you could kind of do that for a large share of the population. For an annual wealth tax, we felt like you could only, do it really for kind of the very wealthy. So you could do it at the top end of the distribution for very wealthy people, because that means you have a relatively small set of people, many of whom already have their business or have their assets valued in various other ways, or have an accountant who's already keeping track of their wealth to some extent. And so that makes it slightly easier. We felt it was harder to do something that was a wealth tax that covered a large share of the population, and particularly in the context where we have other mechanisms in the UK, like capital gains tax, that are relatively effective, or can be relatively effective for that larger group. And so what we kind of recommended for taxing wealth better was actually just to reform the existing taxes for the most part, and potentially to have an annual wealth tax but really focused on the top end. What that means for New Zealand is a bit harder. I know that you don't have a capital gains tax in quite the same way. And there's the 10-year rule, 5-year and then 10-year rule for the Bright Lines test. Personally, I would still, I know the politics of it is particularly hard in New Zealand because of all the experience that the parties have had over talking about capital gains tax. One thing that I think is instructive, and I'll kind of wrap up on this, is in the UK, it was the Labour Party, so the left-wing party, who reversed a policy that the Conservative government had of taxing capital gains like income in the 90s, kind of similar to the New Zealand story. The Labour, the left-wing government here was sort of trying to appear more centrist and more serious about the economy. And one of the things they did was to actually reduce the taxation of capital gains, which is not normally the party you'd think would be taxing capital less. I think there's now widespread recognition that this was a mistake. The Conservative government in the UK, who are currently in power, have no, as far as we can tell, desire to kind of return that. But I think it is the case that the left-wing parties have sort of realized that was a mistake, and are willing to kind of look back at things they've done and say, look, we did those things. They were kind of reasonable. The zeitgeist at the time was that this was a reasonable thing to do. Lots of countries were doing it, and lots of leftish wing parties were doing it. We've realized that was a mistake, and we're willing to kind of relook at that decision and to actually probably reverse it. So I think it is also, I know the politics of these things are hard, and I'll hand it over to Robert in a minute to talk about politics, but it is the case that parties can sort of say, look, there were things that are reasonable then. We realize that they weren't such good moves now. And to some extent, we might want to reverse some of those decisions. So I'll leave it there, and there'll be plenty of time for questions, I think.
Thanks very much, Arun. Yeah, it's just remarkable how similar some of our experiences have been, although to some extent you seem to have had slightly more positive levers that you can call on a little bit in the UK. I guess one thing we haven't really given much consideration to in New Zealand is the idea of a one-off kind of COVID pandemic sort of idea. Robert, I'd like to hand over to you now. And Robert is a campaigner, tax justice, sort of a bit like us in New Zealand. But Robert, over to you.
Thank you very much, and great to hear from Arun, who we work with quite closely. So I'm going to start off by giving a bit of a kind of background to the sort of history of the tax justice movement in the UK and what I think has been achieved, and then talk a bit about our current strategy, and then maybe where I think some of the future of campaigning is going. So just incredibly briefly, Tax Justice UK has been around for about 4.5 years. There are 2 tax justice organisations based in the UK, so us and the Global Tax Justice Network. Tax Justice Network has a global focus, and they actually helped incubate and set us up about 4.5 years ago. And so we have an explicit focus on the UK and UK domestic discussions. So in terms of tax justice in the UK, I think the real moment that gave it political and public impetus was the financial crisis in 2008, followed fairly swiftly by the election of a Conservative-led coalition government, which was determined and did impose spending cuts and austerity. And so this created a sort of public moment where campaigners who were saying, look, you have some very big companies and some very rich individuals who are not paying their taxes properly, and yet at the same time the government is cutting spending. Surely we could be doing more to crack down on tax avoidance, and that might make some of the cuts less quote unquote necessary. And then so there was a really interesting coalition that came together in the sort of early 2010s, a mixture of professional campaigners, so people such as John Christensen, Richard Murphy, Prem Sikka, who had been working on tax justice for many, many years and starting to highlight the problems and the way in which big companies and rich individuals could avoid paying their tax. So the professional campaigners on the one hand, a coalition of students and activists and more public-facing people. And there was particularly an organisation called UK Uncut that did some quite fun, silly actions where they went and took over bank branches that were involved in tax dodging, or the shops of phone companies, and in quite a playful way were really highlighting how these big companies were not paying their fair share. And then the final part of this sort of slightly odd coalition was a number of journalists who really started to understand the problem of tax avoidance and could start to explain to the public how big companies and rich individuals were able to reduce their tax bills. And I think over the course of several years, this built both public awareness of the problem and a real deep sense of public anger at the unfairness that, they were being asked to pay their taxes. At the same time, we were having public spending cuts, and at the same time that the rich and powerful were able to not fulfill their obligations or dodge their taxes. And so this created a kind of really interesting political moment. And actually, if you look at the polling from the early 2010s, but also the polling now, it's in terms of people's views, one of the questions we ask is, do you think tax avoidance by large companies is morally wrong, even if it is legal? So that's the question we ask, and the sort of responses we get now and 5 or 6 years ago, it's sort of 90% of people believe that, and that's almost sort of like dictatorship levels of support for action when it comes to clamping down on tax avoidance and tax evasion. It's just like almost universal feeling in the UK. And I would say, I'm more of an expert on the UK, but you can see similar levels of public anger across Europe. And so again, I think this mixture of activists and campaigners on the one hand, professional campaigners and policy experts, and the media has been really interested in raising this issue up the political agenda and up the public consciousness. And this translated into political action. There was a particular moment I remember. I was actually working on anti-corruption campaigns at the time, where David Cameron, the then Prime Minister, Conservative Prime Minister, went to Davos and gave this big speech. And the speech is mostly remembered for him promising a referendum on EU membership, and we all know how that ended up. But also, as part of the speech, he said to business that they needed to wake up and smell the coffee around tax. And this was a particular reference to Starbucks, which was in the news for not paying their taxes. And so this was a real moment where political figures realized that questions around tax avoidance and tax evasion were something that they needed to think about and take seriously. And you saw reactions from companies as well as from policymakers. And one of the things that I think is perhaps a slightly untold story is a slight story of success, actually, around changing attitudes in the UK to tax avoidance and tax evasion, and that translating into politicians being aware that they need to do something. And, you know, we have seen some policy change in the UK, but also globally. So, for example, there is now much more information that is both available and exchanged on where people have their assets around the world. So, for example, if you're someone who's really rich, you know, once upon a time, you could have a bank account in Geneva that you conveniently forgot about and forgot to tell the tax authorities. Now, if you want to evade tax, you have to be much more active in terms of how you're structuring your affairs. So I really do think there has been successes in terms of policy change. I also think, and this is much harder to measure, I think there has also been some changes in attitudes from business and from rich people about how acceptable certain practices are, and that has led to changes in behavior. So I think from a tax justice point of view, the last 10 years have really been one where there's been success around getting issues of tax avoidance, particularly by big corporates and by wealthy individuals, onto the political agenda, leading to shifts in policy and shifts in behavior. So that's a sort of quite a success. Now, obviously, there's a lot more to do, but I think it's really interesting to see that a relatively small tax justice movement has been able to have, I think, quite a lot of impact in the UK and in Europe more generally. Now, an area where there has been less success, and this is what Arun has been talking about, what we're working on, is around the taxation of wealth. And so, as Arun has outlined, there are lots of ways in which wealthy people are taxed at a lower rate or are able to use various legal mechanisms to reduce their tax bill. And so at Tax Justice UK, one of our kind of like our big prime focus is building support and momentum to get wealth to be taxed in a more effective way, and really to make the point that politicians and as a country, we have choices about how we tax and who we tax. And we're starting to see a bit of progress on that as well. So just to give you a little vignette, my colleague was at the Conservative Party conference a month and a half ago, and there was a panel run by The Spectator, which is a right-wing newspaper, on tax, and the first 3 questions from the audience at this Conservative conference were about why we're not taxing wealth more. So these things are starting to filter through. So I'm going to briefly talk about what we do as an organisation. We have a strategy that is really about how do we build momentum to achieve progressive tax reform. We do very little in-house policy work or research work or analysis. You know, we partner with great people like Arun and other academics and experts who really do a lot of that deep thinking. We're much more about, okay, what's the politics around this? And so the 3 things we do. The first one is around movement building. So we are interested in how we build a strong tax justice movement in the UK. So bring in trade unions, campaigners, NGOs, charities, academics, journalists. You know, how do we build that strong movement and create sort of ecosystem around that? But we've also done quite a lot of thinking about how we reach out to other movements that might be interested in tax, but maybe don't feel comfortable about talking about tax or don't have the expertise. So we've been doing some work with groups working on climate change, groups who are working on sort of social care and anti-poverty, to just help them think about how they can incorporate tax into what they're doing. And our view is the more powerful a movement we can create, the more power we have as a tax justice movement. And so that's the first thing, movement building. The second one is around shaping a public debate on tax. A lot of the media narrative on tax in this country is dominated by right-wing, libertarian, anti-tax narratives that say tax is a burden, we should be cutting tax, government is wasteful, we should be cutting tax. And so we've been trying to work with the media to get positive stories about tax into the media, but also just a sort of pro-tax view in the media on questions around tax. And we found that reasonably straightforward to do. You know, new newspapers generally feel that they have to have some sort of balance, and so they'll often be looking, you know, they'll often be open to hearing a pro-tax voice, and there aren't that many in a sort of organized, coordinated way. So really thinking about how we can inform the media and public debate. We've also done quite a lot of public attitudes work. So we did some focus groups and polling to really understand, what does the public think about tax? What does it think about wealth? There are some positives in there and some also things that are pretty challenging for us as campaigners, but it's important to understand our starting point so that we can help shift the debate. And then the final part of our strategy is around politics. And so that's engaging with political figures. You know, we have, as you can imagine, a more open hearing from politicians on the left, but there are also interesting politicians on the right and think tanks and organizations and pressure groups on the right that are also interested in, for example, let's tax wealth more and work less. You know, that's a potentially, there's a conservative line that says actually work is the thing that we should be rewarding, and unearned income, unearned wealth, okay, that's a better place to be taxing. So there's kind of interesting debates happening on the right as well. So the three elements of our strategy: movement building, shaping a public debate, and politics. One quick example of how that all came together is, you may know that there is a global tax deal that has just been agreed by the OECD. The UK was hosting the G7 meeting this year. We were hearing lots of reports from inside the UK government and from other countries that the UK was blocking that global tax deal, particularly President Biden's fairly ambitious minimum tax rate of 21%. So we were like, right, let's see how we can push back against this. We brought together a mini coalition of groups around it. We then did a lot of work with the media, first of all, to expose the fact that the UK government was blocking this global tax deal at the same time it was hosting the G7. And we also worked with opposition parties to really put pressure. And we managed to put pressure enough on the UK government, and I'm sure Biden was also on the phone, that the UK government reversed its position and came out in support of the deal and said that it was a big champion of it. And so I think that's just an example of where we were able to build a little coalition, so build that movement, really use the media as our friend to put pressure on the government, and also engage with our political allies to put pressure on the UK government to change its view on that. So very, very quickly to sort of wrap up, what's the future of tax justice in the UK and in general? And I think the real context for this is around sort of demographic change and politics and what that means for the state. So in the UK, as I imagine elsewhere, we have an aging population now. We have an aging population and an increasingly wealthy population. And that means that there will be an increased desire for spending on health, social care, looking after the elderly, looking after pensions. Healthcare spending in the UK is just increased since, I think since the Second World War, but particularly since the 1980s. And for a long time, that was funded by a cut in spending on defence. But we've now got to a point where there's no more defence spending to cut. And so that means unless we have lots of growth, which we don't have in the UK, state spending is likely to go up and taxes are going to go up. And so we've seen that this current UK Conservative government has raised taxes by the most out of any government in the last 30 or 40 years. And this is a Conservative government. And so that means, you know, it feels fairly likely in the UK that the next decade, if not more, we're going to be debating how we increase taxes rather than whether we increase taxes. And so that means that there's a really interesting opportunity for us to be making the case that if you are going to be increasing taxes, which we broadly support, you need to be thinking about what's the fairest way of doing that, and particularly not just increasing taxes on the working population, but also thinking about how you increase taxes on wealth and on other areas of the tax system. So, and the final thing I'll say is also there's an increasing discussion around the role of climate and tax. So in the UK government gets about £30 billion a year from fuel duty. I think that's about 3 or 4% of the total tax take. That is going to disappear when you are no longer going to be able to drive fuel cars. You know, in the UK, you won't be able to buy a petrol car in just over 10 years. And so there are going to be big debates around how we think about climate and tax in a way that is fair and progressive. And that's not just because it's the right thing to do, but it's also because it's the politically smart thing to do in order to bring the public with you. So just to wrap up, we are a very small organization. We're 4 people, but we have, I think, in the 4.5 years we've been around, had quite a lot of success at just starting to get more of a public and political conversation on how we tax wealth more. And we've tried to be smart and strategic about our strategy and our approach that brings people with us and leverages our power and our political power to try and have a bit more influence.
So I can see that Peter asked about inheritance taxes and why annual wealth tax experiences internationally have been a bit less good than inheritance taxes have been. So I think the answer to that question is, it comes back to this point about sort of valuation including all assets. So there's sort of 2 big things. So one is, if you don't include all assets, it naturally becomes seen as unfair. It's unreasonable because someone will say, look, you're taxing small businesses, but you're not taxing houses or pensions or something. You exclude pensions, but you're taxing small businesses. I run a small business and I don't have a pension because my small business is my pension. One day I expect to sell it, and that's where I'll get all my money from when I retire. You're taxing me on what I'm getting, and you're not taxing that person who has their, gold-plated civil service pension, which is no longer gold-plated, but everyone says it is. And therefore, that's an unfairness, and so that makes it unpopular. The other is that the valuation is hard, and that does mean, and that's a big reason why, in practice, a lot of assets are either excluded or there, some kind of formulaic approach is taken to valuing the assets. You say, look, we don't know what your business is worth, we'll just multiply something by something to get you a number that is the value of your business. And for some businesses, that'll be too high, and for some, that'll be far too low. And it's those kinds of things that really, in the end, get in the way of it. So in the German system, for example, the German wealth taxes, their constitutional court said they weren't allowed. And it wasn't, they said that, it's often misunderstood. They didn't say that you can't have a wealth tax. They said you can't have a wealth tax where you're not valuing all assets equally. That was the problem they had there. In France, they excluded certain asset classes. That meant that actually it sort of ended up being slightly a wealth tax on more of the middle class than the very top end, because the top end could do more things to not end up having wealth in the form that was taxed. And that led to it being unpopular and being repealed. That's important because, touching on this point that Robert made about climate and climate justice, people are sometimes aware internationally of this Gilets jaunes movement, this yellow vest movement, and the fact that people were very angry. What they were angry about wasn't that fuel taxes went up. They were angry that fuel taxes went up at a time that wealth taxes were scrapped. That was a thing that was very unreasonable, that you're not taxing. I mean, wealth taxes were still seen as a tax on still the very top end relative to the average person who all pays for fuel. So I think there are, and we have a paper specifically actually written by someone from the OECD on international experiences of wealth taxes, showing that really it's not so much that they failed because they had to fail. They failed because they weren't designed well in ways that we do know how to solve, and that those things led to a system in which political support was then chipped away by parties that didn't like it anyway, and they kind of just exposed the fact that there were problems in the system. And that's, I think, why we're very specific when we talk about wealth tax from the Wealth Tax Commission, that you do need to design in a particular way to do it, and that's what makes it, in a sense, kind of expensive to do if you're doing it for a large share of the population, which is why we think it works better at the top end. If you design it for a larger share of the population, it's either quite expensive to implement or you do it badly, and when you do it badly, that's what leads to these kinds of problems.
We also have a question around the recent OECD work, pillars, the 2 pillars, and whether or not it could adversely affect a country like New Zealand. So we're not developing, we're not sort of very rich either. What impact do you think we might, as a foreign capital importer, will this have little effect? Will the OECD reforms, what kind of effect they will have on our tax take? Too soon to tell?
I mean, I think, so in terms of Robert, you can take it if you want to take it. So I think, in terms of the minimum rate, that I think sets a floor that, New Zealand has a corporation tax rate that's well above that floor.
Yes.
So I think it supports the ability to have a tax rate the floor at the moment is 0. So raising that floor is good because it means that it slightly discourages people from, companies from moving themselves overseas. They don't know how important that is in New Zealand, but certainly in the UK it is. There are some cases where we think of, it being a problem that people can move overseas, and having that kind of reducing the gap between what we're charging as corporation tax rate in other countries is kind of helpful. In terms of how much money we'll get from the other pillar, that's kind of reallocating some amount of
the formula, I think.
It looks like it's pretty small in terms of what we'll get. The formula that's been used for people who haven't been following it is the amount of wealth above the amount of profit above some threshold will be taxed at a certain rate that we handed out across countries. that hasn't been very ambitious in the end. So it's not very many companies that are covered by that, and it's not very much of their profits that's covered by that. Relative to, say, in the UK, we have this sort of digital services tax that's been started and that we're possibly going to scrap in exchange for letting this go through. That's what the US would like us to do. It will be less, we think, less revenue than that tax currently brings it. So it will be a reduction from on that base, but we hope that potentially it will be an increase from, there'll be some increase from the fact that corporations will have less of an advantage from moving overseas, because the gap between our corporation tax rate and someone else's will be.
Eventually, it's not going to take place for a while, is it? Robert, do you want to comment on that? But I also have a specific question for you. Perhaps elaborate on that issue. And also, Hazel asks us, what is your comment on, is there any feel or information, empirical data on the political impact of COVID on people's willingness, do you think, to pay more tax?
Yeah, on the first one, the OECD tax deal, I think it's one of these, no victory is complete. I would say the fact that we have a global minimum tax rate is great. And the fact that we have an acceptance that tax should be paid by companies partly based on where they have activities, not just on a very artificial idea of the existing system based on, these companies are in theory operating at arm's length from each other. I think that is also a good step forward. The downside of the deal that we have is that it's the US that is going to benefit the most, followed by other G7 countries. And particularly if you are a country in the global south, this is not a great deal for you. So I think it's one of those ones where 5-10 years ago, people would have thought you were mad to contemplate a global tax deal like this. Is it good enough? Absolutely not. We need to keep pushing, and we need to keep making this go further. That's kind of like that's my view when it comes to the global tax deal. In terms of, I'm just pulling up, in terms of attitudes around tax and public spending, it's quite interesting. So we actually did some polling in March 2000, and one of the questions we asked was, I am prepared to pay more taxes myself in order to fund public services. In March 2000, we had 48.5% said that they were prepared to pay more taxes themselves. We did the same polling a month ago, and I think the figure had dropped to about 44 or 45%. That's not a huge difference. I mean, it's within the error of margin. And then I would also add that the UK has just announced a whole load of extra taxes on people. So I would say that's effectively pretty flat. I think there are a lot of people, including me and others, who are like, COVID will radically change everyone's views on everything. And I'm not sure that is the case. What I suppose it has shown is how reliant we are on the state and on public spending and on public services. And in the UK, actually, the government has put through a number of tax increases saying this is to pay for COVID or to pay for, the results of COVID, where actually that's not true. It is to fund a general increase in spending. And so I think COVID will have changed some of the political dynamics. I'm not sure if it has changed underlying fundamental public attitudes around tax. I mean, in the UK, we've seen a trend really for the last 5 or 6 years with public support for higher taxes and a bigger state increasing. It sort of tends to go in a bit of a wave, a bit of a yo-yo, which tends to slightly reflect where government spending is at. But for the last 5 or 6 years, we've seen a trend of increasing support for higher public spending and higher taxes. Something that we're worried about is, this after a decade of austerity, there is real gaps in our provision of public services, and with an aging population, it is going to cost more to provide the same. And so there is a real risk that people will see their taxes going up, but won't actually see that feeding through into an improvement in services. And so that's something that I think progressives who believe in a higher, more progressive tax system to fund higher quality public services need to be really wary of.
Yeah. Okay, thank you. Perhaps back onto the theme of inheritance tax, a question from Peter Fawley on whether the 7-year clawback rules have been sufficient to stop wealthy gifting their taxes. But I also just sort of wonder, how does, out of my own interest, how does that rule or those rules compare with the Irish CAT scheme, which has a lifetime approach to inheritance tax? So,
Fine.
Arun, could you, over to you?
Yeah, all right. So many people won't know the UK or Irish system. So just want to give you 2 seconds on what that looks like. So in UK, you have an inheritance tax. It is after a reasonably high rate, a reasonably high threshold where nothing is taxed. It's a 40% rate. In practice, nobody pays 40%. So the average rate at about £2 million of assets, which puts you in kind of the top 1%, is about 20%. Then it falls down actually to about 10%. I'll come back to that point. We have this 7-year gifting rule that means that any assets you give away, if you give them away and then die within 7 years, then some amount of that value is included in your estate in terms of tax. So if it was a year later, the whole thing is included. It tapers off so that by 7 years, it's like a small share of that is still included. And the idea there is to stop somebody saying, oh, I know I'm about to die, I'll give everything away just before I die, and so therefore nothing is taxed. Great. So you don't want that kind of someone to have that kind of behavior, and so that's what the 7-year rule is. The 7-year rule doesn't work that effectively. If you are sufficiently wealthy, you can divest yourself of a decent chunk of your assets quite a lot sooner than that. One of the solutions to that, one of the ways in which people do that, is something that came up in one of the other questions, which is that people put things into trusts, and then you kind of get that money into a trust. The way that we tax trusts is a bit different. So if you give it to a trust, that's not in your estate. It's what it's taxed as is there's an entry charge into the trust. So there's a certain amount you pay for putting something into the trust. And then every 10 years it pays us, there's a certain charge that we charge, and that's sort of to mimic some idea of an inheritance tax, because that trust can last, hundreds of years. And there are trusts that have already lasted hundreds of years. And so you kind of need to account not just for that first generation's some point inheritance tax, but the fact that this can go through multiple generations. I think that as a structure is not a bad idea. The problem for us with taxing trusts is that we have a relatively low charge every 10 years, so 6% every 10 years, and we have a lot of reliefs that mean that you can actually avoid both the entry charge and anything at the 10-year charge. So if you have, at the time that 10-year charge is due, and for a little bit before, had those assets be a particular class of shares, you could not have to pay anything. Same is true at entry. If you have agricultural assets in there, so agricultural land, that's not taxed. And that's a problem because you have people who are not in any way farmers who go and buy up chunks of land because they can have that agricultural land and use it to get around this tax. So there are problems with the way we do it. But in principle, that idea, I think, is a good structure. I think the rate could be higher and some of those reliefs could go. How does that compare to the Irish system? The Irish system is essentially a kind of gifts tax. So instead of taxing based on the inheritance kind of structure, it's taxed on what your kind of gift receipts. And so that means that it has the advantage that it is capturing all gifts through lifetime. Administratively, it's harder. I haven't spent a lot of time looking at exactly how much their administration costs are. It's one of the things actually that at some point we are planning a new kind of scheme to go and sort of think about inheritance tax more deeply, to think about how their kind of administration costs look. But in principle, it's a system that I think some people prefer as a structure, because you could tax the person who is, say, receiving gifts on the total amount of gifts they receive. And that's nice because if I have £1 million and 10 kids that I'm sharing it between, and my brother has £1 million and one kid, the kind of effect of that inheritance is quite different. The £1 million going to one kid is worth a lot more than the £100,000 going to 10. But we would have the same currently inheritance tax charge that we both pay on our estates before that got handed over. So that feels like a reason why you might want to divide it up based on how many people get it. So there are things to be done. Compliance costs, someone else about compliance costs. I think that they're not, for an inheritance tax, certainly, for even with the trust structure in the UK, they're not super high. In fact, they are one of the lower kind of compliance costs. We probably should do more to check some of the things. So I think the cost should be a bit higher in terms of checking compliance. But the one thing I just wanted to come back to, and then I'll wrap up on that, is this thing I said about the rate going up and then coming down. I think one of the reasons inheritance taxes are undermined is the fact there are often reliefs. And that means that actually what we see in the UK is that as you get to kind of higher levels of wealth, people make use of various kinds of reliefs that are available, like these special classes of shares, like ownership of agricultural property or ownership of private businesses. And those things lead to much lower tax rate. And that is a kind of a bit of a problem. That's one of the big issues that we have, is trying to make sure that we get rid of those. And that's where the rubber hits the road on some of these trade-offs, because you'll have very powerful groups who will come out and say, look, we absolutely, for farmers, we absolutely can't have our family farm broken up. That would be totally unreasonable. So we should have an inheritance tax relief for that. And you can kind of understand the logic of that potentially, except that what that leads to is, one, harder for someone who's not a farmer already to get into farming, because if they don't inherit some land, they kind of can't get any. But two, you then have people who are not in any way farmers who are buying up chunks of land to kind of do it. So I think we do need to think a bit about what we have available in there for release. So I think that's the other kind of thing I want to say that's important.
Robert, I wonder if you could elaborate on Tax Justice UK's views on inheritance taxes in the UK.
Yeah, it's difficult. So if you look at the polling, while tax avoidance is, action on tax avoidance is incredibly popular, inheritance tax is incredibly unpopular. And one of the things, and I can share it in the chat, one of the things that we found with our public attitudes work is it's not just that people think they'll pay it, but it really gets in the way that people have a very strong sense that it is their duty almost to look after their family and themselves and to generate wealth that will support themselves and their family. And partly this is around property. It's very difficult to buy property in this country and you need family wealth to do that. And partly it's around looking after yourself in old age. And so there's a real instinctive dislike of inheritance tax in the country, and something that we as progressives need to do, and I fear have not done enough, is really think about how do we start to turn the tide on attitudes around inheritance tax. Because from a design point of view, it's a really great, it's a good tax. It makes sense from raising revenue, from inequality, from like a whole range of reasons, but politically it's toxic. And I would say it is one of the taxes that would be on the chopping block if a Conservative government had any money to cut taxes with. And so I think that's really, really interesting. And one of the reasons why I think understanding what the public thinks about tax and public spending and wealth is a really helpful starting point. The last thing I'll say around that sort of issue, and I'm going to put our report in the chat, is that this type of public attitudes work gives you your starting point rather than what is the limit of what you can achieve. Public attitudes can change and can change really quickly, and good campaigning is all about changing attitudes, but it's important to understand where you're starting. And the starting point is people really don't like inheritance tax.
Picking up one quick thing on public attitudes, I think it comes up in one of the other questions that was asked. There's this question of, is it the case that people only want taxes that other people pay? I think that comes up quite a lot, and that's not. So I should have said that the commission, one of the things we did was have a whole big public attitudes section we commissioned, and that's really not the case. So certainly people would much rather have a tax that somebody else could pay. But if you compare, say, how much people were willing to, how supportive people were of wealth taxes compared to how much they're supportive of increases in the top rate of income tax, which is something they also mostly won't pay, people were not very in favour of increasing the top rate of income tax if you look across the public in the UK. I think that's largely exactly back to this point that Robert made earlier, which is people see that as sort of almost deserved. People are working for that income, and so it's sort of wrong for the government to come in and take that away. Obviously, there are people who would support a higher rate. There are people who would never support a higher rate and want it lower. But generally, people were much less keen on that. People were, actually quite keen on a wealth tax because it's seen as something quite different. It is this tax on what sort of seems as unearned. And I think that's particularly important in the context of inheritance. Again, coming back to this inheritance point, because as I said, inheritance has become increasingly important. It's probably true in New Zealand as well, but it's certainly true in the UK, that as wealth has risen, the kind of wealth gaps are much larger. It's much harder to work your way up in terms of wealth. And so the impact on your lifetime resources, effectively, you think of your lifetime resources as all of the income you'll ever earn and whatever you might get from your parents, that share that you might get from your parents as a share of your total kind of lifetime resources has gone up quite a lot. And it's really, really hard now to kind of buy a house in certain parts of the country. It's really hard to kind of make certain kinds of progress without access to those things. And that matters because also even in the UK, the way schools are done, even if you're in the kind of state system for schooling, it varies a lot by where you live. And people who have more wealth can go and afford to live in the areas where the nicer schools are. And so even if in principle we have a state school system, the differences in provision are then, wealth differences magnify those things. And so we're very aware in the UK that inheritance is becoming an increasingly important issue. And actually, while, as Robert says, it is actually one of the least popular taxes, it is increasingly important, and actually sort of more needs to be done to try and kind of think about the effects of inheritance, because that wealth gap is rising, and the gap between people who will and won't receive inheritances is getting bigger and bigger. So it is a really important issue, certainly in the UK and probably in New Zealand as well, as wealth rises compared to incomes.
Okay, well, thanks so much. I mean, just so many great points that you've made, so many that are relevant to New Zealand and for us understanding the world as well. Look, what you've been talking about is fantastic. There's just so many issues that are so common to us, some differences, but, the contradictions between, the fact that inheritance tax just makes so much sense, yet it is the worst in terms of public attitudes, is is a challenging one. Certainly, I remember, I think that OECD 2018 report, if that's what it was, which looked at wealth taxes, that came out very much in favour of inheritance tax, in fact, as far as I remember, rather than wealth taxes. But I don't think they did any public attitude surveys, as far as I know. No. So that really goes to show the importance of framing, of communicating, of engaging. You know, it's difficult, and good on you both for providing the academic grunt, Aaron, and for, you know, demonstrating just what a good activist tax justice can do, because you have had your successes. And as we all know, you know, as you say, 5 years ago, we would not have thought we were here when we were talking about a global minimum tax and at least a degree of formulary allocation of profits to be taxed, even if it's not working out in the most perfect way at the moment. And thanks very much also for sending resources to us, Robert, and your email. We will certainly be circulating those. So thank you very, very much. Yeah, look, we've got resources coming out our ears here. Thank you so much. I'm really grateful. I'm sure everybody is really grateful for getting up so early. Thank you very, very much indeed. And